Hello and welcome to the lecture for Unit 4 of Topics in Governmental Financial Analysis. The last unit we were looking at measures of where a government stands at a particular point in time, which you can generally wrap up in the term financial position, although we also looked at concepts that leap off of that point in time measure, like solvency and liquidity, coverage, leverage, issues like that. What we're going to start looking at now is changes in financial position, and this week in particular looking at analysis of revenues, increases in the improvements in the net position of a government or of the financial position of a government. What we'll cover in this overview obviously is start with talking about in general what revenue analysis is, before jumping into the specifics of the various analyses that you can do to inform issues about revenues. I want to say a little bit about governmental revenues, the typical types of governmental revenues, some issues that you ought to be mindful of, and then we'll start talking about the various things that you ought to be looking at when you're looking at revenues, in particular analyzing the bases, the economic activity that is being taxed or that is being charged in order to produce revenue, as well as the rates that governments apply to that economic activity in order to produce the revenue. And then we'll also look at some other issues that are related to revenues and that help you to understand the healthiness of the revenues that a government has. So what is revenue analysis? There's not much mystery in the term. We're analyzing a government's revenues, its inflows of resources. What resources are coming in on an annual basis that it can use to pay the costs of operations, to provide services, and to pay off their liabilities as they come due. We were starting to stray into this area when we were looking at things like coverage, where we're looking at the sufficiency of a government's inflows of resources to cover its debt payments or its payments for other types of liabilities, and certainly we'll see a little bit more, in looking at the income statements, such as the government-wide statement of activities and the information that they contain, and how that's useful for, judging whether a government is going to continue to bring in sufficient resources in it each year, so that when debt payments and other maturities for liabilities come, the government is fully flush and able to make payment or otherwise satisfy those liabilities. We're going to want to look at where those revenues come from. What types of revenues does the government have? What type of control does it have over the raising of those revenues and how they're used? What type of diversity does it have in its revenue portfolio? Those are all important issues for judging a government's financial health. And of course, it's important to look at these revenue sources over time. Where have they been going over the past 5 to 10 years or even longer, and where are they headed? Because as we should understand by now, looking at historical trends in finances of a government is almost never just an academic exercise or the work of an historian. It's meant to help you judge where the government's going to be in the future. So if a municipal bond analyst is looking at historical trends in coverage, debt service coverage, for instance, the reason they're doing that is because they want to try and assess whether the government in the future is going to be able to continue to pay its debts. And that's the same with any type of analysis, and it's true as well here as we're looking at revenue analysis. So before we jump into looking at the different aspects of revenue analysis, as I said, I wanted to say a little bit about the types of revenues that governments have and some things that we ought to be mindful of about them as we're trying to analyze them. The most significant revenue source for general purpose governments, at least states, counties, cities, towns, villages, and school districts as well. Since although they are special purpose governments, they finance on a model that's much more like a general purpose government. Uh, would be taxes, and in particular, when we're talking about local governments, property taxes are king. Not nearly as much as they used to. If you look about 100 years back, property taxes accounted for almost all of the revenue, all of the inflow of resources for cities and other types of local governments. That has diminished over time as governments have come up with other forms of revenue in order to diversify their revenue streams, as it became more and more difficult to raise taxes on property, and as a variety of federal programs that provided revenue to state and local governments came to the fore and grew, and then over a subsequent period of time started to decline, and governments then looked for other sources of revenue rather than turning back to the property tax. But even though they're not nearly as significant as they were, at the early part of the 20th century, or even through, say, the middle of the 20th century, they are still, by and large, the most significant revenue source for most local governments. Uh, that's probably closely followed by sales taxes, especially when you're talking about county governments. Property taxes and sales taxes are significant tax revenues for many county governments. Personal income, along with sales taxes and corporate income taxes, are the primary tax revenue sources for state governments, and to a certain extent for some local governments. There are a few scattered cities, for instance, around the country, like New York City, that have a personal income tax of their own, although it tends to be small. And out of the norm are local governments in Ohio, which, rather than relying on property taxes, actually rely heavily upon local personal income taxes. And when you get into corporate income taxes, there's a wide range of taxes that fall into that general category of taxing business. One of the things that's important to be mindful of when it comes to taxes, and this will come up again in a little bit, is that some taxes are general use taxes, meaning they provide resources to the government that can be used for any purpose, whereas other taxes are restricted use, meaning they are intended to be used only for a particular purpose. For instance, it's not unusual for there to be a motor vehicle tax or a gasoline tax that is dedicated to maintaining highways or providing resources for highway construction. All taxes in the statement of activities at the government-wide level are reported as general revenues um, because they're not produced by a particular activity of the government. They're not program revenues, so by definition they must be general revenues. But it's important to remember that it's possible that if you're looking at a government, not all of those tax revenues may be available for any purpose. So if you're looking at how individual taxes have grown over time, it will be relevant to know whether those are taxes that can be used for general purposes or not. For instance, think of a government that has two big taxes. One is a property tax that can be used for any purpose, and the other one is that motor vehicle tax I talked about. And the general taxes over a particular period, the property taxes might have grown by 50%. But spending grew by 70% during that time, and the the motor vehicle tax grew by 90%. Now that's promising that it grew by 90%, but it can only be used for one particular purpose because it's restricted to highway construction and highway maintenance. And so it doesn't really help to support the overall financial health of the government. It certainly contributes by providing resources that are needed for an important service, and resources that can be used to support the infrastructure of the government, which is very important. But it doesn't help at all to deal with the problem of spending growing at a faster pace than that government's most significant own source revenue, which is its property tax. After taxes, intergovernmental aid is probably the most significant source of revenue. And what we're talking about here, obviously, is revenue that is provided from one government to another, mostly in the form of what is known as categorical or programmatic aid, meaning those grants are provided for a very specific purpose. That's the only purpose that a government that receives the money is allowed to use it for, like education aid. Is probably the best example in terms of money that flows from a state government to local governments and to school districts. That money can only be used for education. If it's flowing to a school district, you expect that's how it's going to be used. But if it's if it's not an independent school district, it's one that's a part of a larger government, like in New York City, which has a Department of Education, but it's not an independent school district. It's a part of the larger budget of the city of New York, and education aid from the state government, from the federal government, flows into the city, and then is spent by the city on education, and there's a certain amount of accountability that has to take place there to prove that, in fact, all of those education dollars were used for education. But they can't be used for other purposes. They can't be used for police or parks or sanitation. A much smaller portion of intergovernmental aid is unrestricted aid, which is just support. Now, that same education aid we were talking about, if it's going to a school district which only provides education services, from their perspective, it actually is unrestricted aid. Yes, it has to be used for education, but that's all they do. The school district doesn't provide sanitation. It doesn't provide police services. So, in a way, from their perspective, it is unrestricted support. Colleges and universities receive state appropriation aid that is just general aid to support the operations of that government. The provision of unrestricted aid to general purpose governments is relatively non-existent now. There's very little revenue that governments receive that doesn't from another government that doesn't have some type of string attached to it. Prior to the Reagan years, governments used to receive revenue sharing. There were states that did state revenue sharing, where they raised some revenues and they gave a portion of it to the local governments. That is much less common now, and in fact, in a lot of states, totally non-existent. After taxes and intergovernmental aid, charges for services, fees, and fines are probably the most significant next source of revenue, and they've been growing a lot as intergovernmental aid has waned, as the ability to raise taxes has been more greatly constrained. I think probably the best example of this would be the state of California, which has Proposition 13, has had it for a long time now, for decades, that very severely limits the ability of local governments to raise property tax revenue. And so California governments turned in large part to charges and fines and fees in order to make up for a lot of the revenue that they weren't getting because they weren't able to raise their property taxes as much as they wanted. These are the kinds of things that are going to appear along with intergovernmental aid, at least categorical or programmatic intergovernmental aid, in the program revenues section of the Statement of Activities. We're talking about things like permits for ball fields that the Parks Department might charge. We're talking about maybe parking permits or parking tickets. A moving violation, and other fines that the police hand out. fines from the health department for violations by restaurants, or by the buildings department for violations by construction companies or landlords and other property owners. Investment earnings, provide a decent amount of money, but in the grand scheme of things are relatively small, especially compared to taxes and intergovernmental aid. And it's the one area that is highly unpredictable. There's a certain predictability to taxes, even though governments sometimes don't get the numbers quite right when they're budgeting. The economy might not be as strong as they expect, or it might be stronger than they were expecting. Um, and that will affect, at least along the margins, the amount of property tax and sales tax and income tax that they receive. But investment earnings, there can be years when, rather than investment earnings, they have investment losses. Like 2008, when the stock market went south, there were a lot of governments that lost a lot of the value of their investments. They weren't getting any income; they were actually losing money. And then lastly, there's a number of other revenue sources of much less significance, that will together fill in the gap between what is raised through these primary revenue sources and what is needed to fully finance the spending of the government in any given year. So with that said, that background, let's talk about starting with common size analysis, meaning percentage distribution and percentage change. If you're looking at the statement of activities, the revenues are spread out around the statement, but you want to look at them individually here, because you want to know what portion of the total inflows of resources of this government comes from these various sources. So you've got your charges for services, your operating grants and contributions, your capital grants and contributions up here in the program revenues area, and then down below here where the general revenues are, all your taxes are here, your unrestricted intergovernmental aid and contributions, investment earnings will always be down here as well. As you know, percentage distribution, you're going to take each individual dollar amount for these revenue sources and divide them by the total revenues, which are down here, 99,537,830. So in each case, you're dividing it by that total, and you get these percentages. Well, this total number is so close to 100 million that the percentages come out very close. You probably could have guessed them without actually doing the calculations. But you look at this, and what you see is that most of this government's money comes from the property tax, and most of that from its general levy, meaning the property tax levy that can be used for any purpose. There's also a separate property tax levy specifically for repaying general obligation debt. What happens a lot of the time is that even for governments where there are limitations on how much they can levy in terms of property taxes, the amount that they're allowed to levy for debt service is unlimited. They can levy as much as they need to make the payments that are coming due in the coming year. So they will show those levies separately so that taxpayers know that this portion that we raised and that we're charging you, we need to repay our debt. And so that's a separate thing. We're only going to use that to repay debt. The rest of this amount is the part that is for general support of the government's activities. You can also see here that this government gets about 10% of its revenues from categorical grants for operating and capital purposes, plus another 1.5% in unrestricted. That's relatively low for a local government. I think it's not unusual to see a local government up in the range of 20% or more. It depends. It's going to vary from state to state, especially in states that provide more support to their local governments, or have more programs that they expect their local governments to participate in. That number is going to be higher. Now, there are two things that are important, well, three actually, I think, that are important in looking at these percentage distribution numbers. Uh, the first of these is this issue of revenue dispersion, which is how dependent is the government on one or a couple revenue sources. You can see that this government is very heavily dependent upon its property tax, and so you know that if there is a problem in the housing market, as there's been over the last 4 or 5 years, that that government will suffer disproportionately because it is so dependent upon a revenue source that taxes housing values. So if housing values are going down, a government that's heavily dependent upon a property tax is going to be very heavily hit. But what you're looking for is to see, okay, it's not unusual for a local government to have a large portion of its budget being funded by property taxes, but are the rest of its revenues relatively evenly distributed, or is there another item or two that it's really dependent upon, and that could really do damage to it financially if it weren't as strong? Charges for services are almost 16%, but that's not one revenue source. I mean, charges for services is a wide range of revenue sources, and so you might want to, if this is a big number, you might want to try and look inside that and figure out, well, where is that coming from? And you can look at the statement of activities information where the charges for services are shown by program and function, and if you look at that over time, that might give you a sense of whether there are particular activities that are generating more and more charges and fees and fines, and then that will help you to get a sense of whether a government's becoming very dependent upon one particular area of charges rather than charges in general. This government also has several kinds of non-property taxes. It has franchise taxes, it has public service taxes, it has some investment earnings as well, and then some other that doesn't fit into any of these other categories. The second thing that you're going to want to take a close look at is the degree to which the government has control over raising these revenues, in terms of setting the rates and how much revenue it can raise, whether it's limited in that or whether it can do what it wants to do. The more independence or autonomy that the government has in raising its revenues, the better from its perspective in terms of its financial health, because it's going to then be able to respond. It has the power or the ability to respond to a budget crisis by raising some of these revenues in order to cover its costs. So looking at this particular government, which ones here does the government have a significant amount of control over raising? Certainly charges for services. In most cases, the government is going to have substantial control over that, and investment earnings as well, because it can decide where it wants to invest its money. It may not have control over the performance of the market, but if it's a risk-averse government, one that is very worried about losing money, then it can pick very safe and sound investments that aren't likely to lose money. They won't earn a lot, but that little bit that they earn, is much more certain than longer-term investments that come with a bigger return, but also come with a lot more risk. What you do need to be careful about here, though, is that it's possible that there may be some limitations on a government's ability to levy charges for services or fees and fines, or some limitations on the kinds of investments it's allowed to have. The latter in particular, there are a lot of states that have laws that limit how much local governments are allowed, or what they're allowed to invest in, and in a lot of cases they're very conservative limitations that say their local governments are only allowed to invest in like money market funds and treasury bills and notes from the federal government, and it may also be possible that there are limitations on how they can raise charges for services, and you should or what they're allowed to charge for. So that's something you might want to look into. Uh, the property taxes, uh, a government may or may not have control over raising, and it may be true for other taxes as well. Um, I'll give you an example. Using New York City, New York City can levy an unlimited amount for debt service, although it's limited by the amount of debt service they're going to have in the coming year. But they can levy that full amount. Uh, they don't have much in the way of a limitation on their general property tax revenue. But that's not true of all local governments. And we just gave the example of California, where they're severely limited in their ability to raise property taxes. Massachusetts had Proposition 2.5, which is not nearly as severe as Prop 13 in California, but still puts a limit on how much those governments can, in Massachusetts, can raise their property taxes. And New York City's other taxes, and it has a whole bunch of non-property taxes, it can't raise those on its own. It has to approach the state legislature and get them to approve them, because the only tax it has the power to raise on its own is the property tax. So New York City's income tax, its sales tax, and its variety of other taxes, each year, if it wants to change those tax rates, it has to ask the state legislature to approve those increases or decreases in the rate. And especially with increases, it's not always guaranteed that the legislature is going to go along with that. And then lastly, government doesn't raise intergovernmental aid. It can engage in certain activities that it knows it can get some aid for, but a lot of aid programs expect some buy-in on the part of the government, that the government that is receiving the grant is going to kick in some money of its own. So that's rarely ever a zero-sum game. And at any rate, those programs have to exist in the first place. So there's very little control by the recipient of the grant over the receipt of and the raising of intergovernmental aid. The third issue, then, after revenue dispersion and pardon me, I actually calculated some of these percentages here so you can get a sense of the control over the raising. If you look at just those two that we're pretty certain in most cases the government's going to have pretty significant control over, I mean, that's maybe a little bit better than 1 out of every $6. It's less than 1 out of every 5, which would be 20%. If you add the property taxes and the other taxes to that, if you find out that they can in fact raise those without somebody else's approval, then it's a very large number that they have control over. But it's going to be somewhere in between that 88% and that 17.76%. Closer to 88%, the happier you are in terms of the government's ability to respond to financial problems by raising revenue. The closer it is to that 17.76%, the more worried you are that if they do face financial trouble, revenue raising is probably not going to be a very significant option for them. The third item then, after revenue dispersion and control of the raising of revenue, is control of the use of the revenue. Once that revenue comes in, can the government use it for any purpose it wants, or is it severely limited in what it can be used for? Again, charges for services in most cases are going to be general revenues that can be used for any purpose, not just for the activity that raises them. General levies for property taxes, unrestricted grants, investment earnings. In most cases, those items are not limited, although you're going to always want to check these. You're going to want to look in the notes to the financial statements to see what they say about it, just to understand it. You may want to look in the budget document. That's another place where you might get a hint about whether there are limitations on how they can use this money. For instance, some of the investment earnings they're reporting, may be a part of a fund where they can invest the money like a permanent fund, and the investment earnings on the contributed amount can only be used for a specific purpose, like enhancements to parks or purchasing sculptures for display in public buildings. It could be any reason. Scholarship fund in a school district if it's being reported as a permanent fund. So it's not a given that all investment earnings are unrestricted, but they tend to be. Other taxes besides property taxes, you need to investigate it and find out whether those are general revenues or despite being reported in the general revenue section of the statement of activities, whether they can be used for any purpose or whether they're limited to a particular purpose or not. Certainly, when I see something that's called public service taxes, I wonder if there isn't some special purpose attached to that. Obviously, the programmatic grants for operating and capital purposes are restricted to being used for a particular purpose, as is the property tax levy for debt service, which can only be used to repay debt. So for this particular government, you look at the revenue sources over which it almost certainly has discretion about what purposes to use it for. 71%, that's not bad. It could be a lot worse, and some of these other items that we're uncertain about would pump that up quite a bit. The franchise taxes and the public service taxes together are another 13%. That'd get you up to 84%.